Okay, sir, let's start.
Okay, fantastic. So last class we started portfolio management. We looked at portfolio management overview. We discussed what the importance of why portfolio management, why we preach the message of, if you want to invest, go the portfolio management route. Then we spoke about the different steps to portfolio management, and I said that the sequence must follow, which is your planning stage, your execution stage, and your feedback stage. Then we looked at your types of clients. We said you predominantly have two categories of clients. You have the institutional clients and the individual clients. And I made mention that for individual clients, your needs and wants are different. However, in the portfolio, in the institutional client spectrum, we've been able to sort of see some commonalities that could help, that helps us to sort of put these guys into a bucket. Yep. And that's why we have the defined benefit pension. We have the endowments, we have the foundations, we have banks, we have insurance, life and non-life, we have sovereign wealth funds. Then we looked at the asset management industry as a whole, how that industry have changed. And I made mention that over the years, we've seen a significant dominance in the passive investment space. We spoke about passive and active investments. Passive is when you sort of don't have a view, you believe that you can add value to the portfolio, but you want to manage the asset. So you manage the asset in line with some pre-identified benchmark, which most likely can be an index. Or you look at it from the angle of, we talked about the, like I said, over the years, dominance of passive investing over active, and all that. Now, we now got to this part, which is pooled interest. Before it used to be called, this section was called pooled investment. Now, pooled interest, which makes a lot of sense now. Yeah. So what do we mean by pooled interest? As the saying goes, when various people have a particular interest in a particular investment. So what do I mean? Yeah, or rather, when several people have interest in a particular investment, that's the right word. Several people have interests, individual interests in a particular investment. Now, what do we mean? Everybody in this class, we're about 7 of us. We can all decide to say we want to buy Dangote shares. Yeah. Or no, don't let me use Dangote shares. So we can all come together to say we want to buy this, we want to buy my house. Yeah. The value of my house, I don't know. Hypothetically, maybe 150 million. I don't know. Hypothetically, just okay, 100 million. Now, Esther might not have 100 million to invest. So what does she do? She reaches out to all of us to say, see, I have this very fantastic idea. We can buy this house for 100 million, renovate it, and I can get you guys, I can get somebody to buy it from us, buy it off us at 120 million. So that means in span of 6 months, how much we'll buy it now? It takes about 3 months to renovate. Say 3 months after 6 months, that's 6 months from the day we bought the house or we made the investment, we'll be selling off this house for 120 million. So technically what that means is that in 6 months, Esther can generate 20% return on our investment. But the issue she has is she doesn't have the 100 million. So what does she do? She comes to us to say, guys, do you want to partner with me, tag along with me on this investment, on this journey? Yeah, then all of us can decide to say, oh, okay, let's tag along. So what do? We all make our contributions. Now, those contributions that we're making is hypothetically, or not hypothetically, is automatically our interest in that investment. So we all bought a house for 100 million. I donated 10. Any donated 20. Michael donated 20, Esther donated 20, like that, we all donated. So basically, if anything happens to this house, my claim to this house automatically is 20%. So it's 10% because I donated 10 million out of 100 million. So basically, that's 10%, that's 100 over that's 10%. I protect, that's like, yeah, technically. So what we're trying to say there is, if in the future Esther decides to sell this house for 120 million, that means I have a 10% claim on whatever the value of that investment is in the future. So that's what we call pooled interest. So in some quarters, we call it commingling. Yeah. So when you bring several investments together to make one investment. And over the years, we've seen several different types of investment products in that light. Yeah. One predominant one, which we all know, are called mutual funds. Yeah. So mutual funds has grown over the years. Yeah, it's like the most predominant investment product that asset management or investment management firms offer. Yeah. So this type of fund is a commingled investment pool in which investors in the fund each have. So this is where I am. Yeah. Investment. Sorry. Apologies. This is where I am. Sorry. Yeah, this is where I am. Yep. So this is a type of fund. This type of fund is a commingled investment pool in which investors in the fund each have a parental claim on the income and value of the fund. So you remember when I was explaining pooled investments, pooled interest, it's not only the future value of the fund that you have your claim on, you also have claim on the income. So let's just imagine that Esther decides not to sell the house after 6 months. Esther decides to make it a long-term investment. So she has seen a bargain to buy a house for 50 million naira, where she can renovate it. Everything will cost about 70 million naira, and she can rent that house. She can rent the house out at maybe 10 million naira per year. Let's even make it easy, 7 million naira per year. So that means every year there's a rental income of about 10%. Now, each time rent is paid, which is 7 million naira, we all have a pro rata claim to it. And that pro rata is determined by the percentage of the total investment that you contributed, basically. So if you remember my analogy before, 100 million naira, I contributed 10 million naira. That means I have 10% claim on the income. So any income that comes, I get 10%. If the future value of the fund of the investment is sold, I have 10%. Yeah. But mutual funds are a bit not straightforward like that. Yeah. So the value of the I'm here. The value of the mutual fund is referred to as the net asset value. Always remember that. So anytime you're talking about mutual fund, there will always be a net asset value. So please always remember this net asset value. Yeah. So, and this net asset value is computed every day. So let me print a picture for you guys. So this is what I'm saying. So imagine I have a mutual fund where I have stocks and bonds. Let's just make it easy, stocks and bonds. So I have a mutual fund where I just have stocks and bonds. Stocks and bonds. Yeah. And for the stocks and bonds, there are different stocks and different bonds. So at the end of every day, we need to determine what the value of this mutual fund is. So at the end of every day, we have to value our bonds, value our stocks to know what the value of that stock is. The value of that portfolio is every day. Basically, that's what mutual fund is all about. Yeah. Now, how do mutual funds work? Let's talk about how mutual funds work. So there's something we call units. Yeah. So every mutual fund has an evidence that you have made investments, which is what we call units. So the units are the evidence that Esther has invested in a money market fund, yeah, or a stock mutual fund. Yeah. Now, the way it works is at the beginning of the investment period, at the beginning of that fund, the asset manager might decide to have, let's say, 100 units, hypothetically. Yeah. And is trying to raise 100,000 naira. That means each unit is what? 1,000. That's the value of each unit. Everybody that comes to buy my mutual fund on the first day would buy it at 1,000 naira. But what happens is after the next day, so let's say the day money is given to me on the first day, let's say somebody bought 20 units, for instance, or the total sale that day was 20 units. So that means the total money I raised that day was 20,000 naira for my mutual fund. Yeah. Now I have 80,000 units left. Yeah. But the total number of units that this fund has to offer is 100, but it's only 20 units that is sold. Now, what happens is the next day, yeah, at the end of this day, I need to determine the value of this 20,000 because the expectation is, apologies, yeah, the expectation is, I know I said apologies, it doesn't sound logical, but the expectation is as the 20,000 is coming in, I am investing it immediately, such that at the end of the day, let's just assume that this 20,000 that I got that day, at the end of the day, it is now 20,500. Remember that it was attributable to only 20 units. So that means this price that is 1,000 naira is what we call, apologies, is what we call, I missed that out, it's called, we call NAV per share. NAV per share. NAVPS. So your day one at the beginning, your NAVPS, your NAV per share was 1,000, but you were only able to sell 20 units. So that means 20,000 naira came into your pocket. But at the end of the day, the 20,000 naira is now 20,500, maybe due to some gymnastics that the fund manager has done. That means at the end of the day, your NAV per share at the end of the day is no more 1,000 naira. It is now 20,500 divided by 20, which from the look of things would be 1,025. If I'm not mistaken. Yeah, that would be 1,025. That means at the end of day one, because of the gymnastics that the portfolio manager was able to do, your NAV per share has increased from 1,000 to 1,025. So now imagine that Amy now comes today. That's the next day, because this is after day one. This is what is running after day one. Yeah. So let's say in day two, Amy now comes and says he wants to buy. He will buy, he wants to buy the out of the 80 units that is left. He will buy at this price. He will no more buy at 1,000 again because things have moved. So that means if any comes and says he wants to buy, he will buy at 1,025. And that is how it keeps going and it keeps going and it keeps going and it keeps going. Yeah. And that's why they always say that if you want to benefit the most, it's always best that you buy a mutual fund at inception. Yeah. But it doesn't matter. Even if you buy after inception, you will still get value. So that's how this mutual fund works. So another thing again I want to mention is the expectation is that at 4 p.m. every day, close of business every day, the fund manager should be able to determine the NAV of that mutual fund and the total number of units that has been subscribed to. Dividing the value of that, the NAV at the end of the day, and the total number of units gives you your NAV per share for that particular day. And it is that NAV per share for that particular day, end of day, that is going to be applicable to investors the next day until the portfolio is valued again at 4 p.m. the next day, where the NAV per share of that mutual fund now changes. Does that make sense? John, I can see that you wanted to say something. Hello?
Sorry, that was an error.
Okay, no problem. Yeah, so that's the whole methodology or the whole concept of how mutual funds work. Now, we have two types of mutual funds. We have the open end, yeah, and we have the closed end. So two types of structures. We have the open end and we have the closed end. Yeah, so let's start with the open end. So the open end is when you hear a mutual fund is open end, what should automatically come into your mind is easy entry, easy exit. Anytime you hear a mutual fund is open-ended, what should come to your mind is easy entry, easy exit. Meaning that the fund manager gives you room for, or rather, let me put it like this. So when you hear open end, let me say it that way. If I say it that way, it might be a bit confusing. So when you hear open end, it means that free entry means anytime you want to buy, there are units available for you to buy. So the fund manager would always make fund units available to you. The fund manager would always collect your money. It is not a case that you get to the door of the fund manager and the fund manager will say, hey, John, it was nice you coming here, but we don't have units available for you. Kindly go. No, the fund manager would always pick up your money and would always give you units. And that's why we call it open end. The second part is if you go back to the fund manager and say, I want my money back, the fund manager will process it. The fund manager will collect your units, which shows that you have evidence you're a unit holder, that shows evidence that you're a unit holder, and it gives you the money, your applicable money to the number of units that you have. So there's free entry, there's free exit. The fund manager dictates that flow. The fund manager gives the liquidity. Every time you come, the fund manager is always available to take the opposite side. So if you want to buy, I give you units. If you want to sell, I give you money. Yeah. But the thing is, every time you buy, the fund manager is creating units for you. Every time you sell, the fund manager is canceling those units. So at every point in time, the fund manager is creating and canceling, creating and canceling, creating and canceling. Yeah, so that's open end. Yeah. Now for closed end is the reverse. So for closed end, there's no free entry and exit. It is a closed, as it's called closed end. It is a closed scheme. If the fund manager says, I want to have only 100 units, it is always going to be 100 units. So if you go to the fund manager and he is fully sold out and he say you want to invest, he will tell you he doesn't have. Unlike the open end where he will always create. So even if he's exhausted, he will create. He will keep creating. He will keep creating. He never stops creating. But for the closed end, once it is shut down, once it is fully subscribed, nothing you can do. He doesn't have. Now, closed end again, there's no free exit. Meaning that if at a point in time you come and you say you want your money, the fund manager does not have the liberty, would not give you cash. The only thing the fund manager can do is it can tell you that it would help you up your unit, meaning that if there's somebody that is available to take on your unit, then it would pass it over to the person collect the money from the person and give it to you. Otherwise, there's nothing the fund manager can do. So that's the difference between open end and closed end. Yeah. So for open end, free entry, free exit, the fund manager is always creating liquidity. Any point in time you want, you would always get units or you always get cash. For the closed end, there is no free entry, there's no free exit. If it's fully subscribed, there's no more body entering. If you want to go out, it's either somebody internal is available or somebody external is available, but somebody must be available, must be willing to buy off you. If not, nothing for you. Also, the fund manager does not provide liquidity. Yeah. Then lastly is fund manager does not. Now, lastly, there's something about closed end that I want to mention. There's a particular problem with closed end. So one thing about closed end you need to understand is something we call discount and premium to the NAV. Discount and premium to the NAV. Now, to the NAV. Now, what do I mean? Now, so imagine a situation where the NAV per share of a mutual fund is 10 naira. Yeah. And Esther wants to go out. Let's start with that. Esther wants to go out. Remember that Esther can only go out if there's somebody at the other side that is willing to what? Take up a unit. So what happens? Esther starts to talk to people. Now, two things are going to happen. If the fund is doing very well, there's a possibility that Esther might sell those shares, those units at 12 naira. Remember that the NAV per share is 10. Esther might decide to sell it at 12. Esther might get somebody to buy it at 12. Why? Because there's demand. The fund is doing well. People want to come in. Now, if the fund is doing badly, Esther might struggle to even sell it at 6 naira. That is when it's trading at a discount. So the first one where she could have sold it, she can sell it at 12 naira, and the NAV is 10 naira. That is premium to the NAV. In a situation where she struggles to sell it at 6 naira and the NAV is 10 naira, that is trading at a discount to the NAV. And the reason why this happens is because of the performance of the fund manager. So if the fund manager's performance is good, she might sell it at a premium. If the performance is poor, she might sell it at a discount. So always remember that. The premium and discount to NAV situation for closed end. Now, another thing again you need to know is what we call load. For mutual funds, there's something we call load. Yeah. So load is like sales commission. Load is like sales commission. So anytime, the way we are in an American world, the way mutual funds work in America is the fund manager is not the one that sells his funds. The fund manager has agents that sell the fund on its behalf. Yeah. So most times, in terms of distribution, in terms of, sorry, I just remembered something pertaining to what I want to do this week. Polaris guy. Chibuzo. Okay, so the way it works is most mutual funds abroad have like a sales agent agreement where you have people that sell these products, they sell this mutual fund on their behalf. And what those guys get in return is what we call commissions. Yeah. You never interact with the fund manager. You would always interact with your agent. The fund manager would always put it out there to say, in a case where you have any situation, please reach out to our agents. So the fund manager doesn't want people to be coming to their office, going and be doing stuff. Yeah. Now, what does the agent get? The agent gets a sales commission. So if I want to subscribe, meaning if I want to invest in a mutual fund, I'll pay the agent a commission. That commission is called a load. Now, at the point of subscription, yeah, so it's what we call that upfront load. Yeah. So at the point of investing, if there's a load, if there's a sales commission you pay, it's called front end load, not upfront, front end load. Yeah. Now, at the point of you redeeming your units, meaning taking back your money, selling the units back to the fund manager to get back your money, you also pay a commission. That commission is called back end load. So for some mutual funds, there's what we call front end load, or rather, they have front end load and back end load. While some mutual funds have only back end load, while some have only front end load. Yeah, so that is the commission that you pay the agents. So let's say, for instance, for every investment you make, you pay a commission of 50 naira. So that means if I want to invest 5,000 naira, that means what will be put into my investment, there are two ways. Is either I give them 5,050 so they can take out the 50 naira commission, or I pay 5,000 and they deposit 4,950 into my investment. At the end of my investment, if I want the investment period, if I want my money back, they will take that 50 naira again. So that's back end and front end. So that's what we call the load. Most funds in Nigeria don't have loads because we don't have that. We don't follow that structure. It's an American structure. Yeah. Okay. Moving on. Now we have types of mutual funds. Yes, types of mutual funds. I always say this, and I say this very easily. Excuse me. The type of mutual fund is dependent by the underlying assets. So we can look at what it is. Differentiated by the type of assets that they invest in. That's what I call underlying assets. So if I am the fund manager and I have a mutual fund where the type of assets I invest in are money market instruments, then it's called a money market fund. If it is predominantly bonds, then it is called a bond fund. If it's predominantly stocks, then it's called a stock or an equity mutual fund. Then we now have the last part, which is called the hybrid or the balance fund. So hybrid or balance funds are funds that I don't have only one asset in it. I have a mixture of assets. So it could be stocks and bonds, stocks and money markets, stocks and money markets, bonds and money markets, stocks and real estate, depending. Yeah. So it could be anything. Yeah. So that's what talks about. That's what your types of mutual fund is all about. It's all dependent on what type of assets are you investing in. So if I'm investing in real estate, then it's excuse me, it's called a real estate mutual fund. Nothing more, nothing less. Yeah. Okay. Moving on. Now, types of other investment products. So what the curriculum tried to do here is the curriculum tried to differentiate a mutual fund from the other types of pooled interest products that we have, or other types of investment products that we have. The most predominant investment product, don't let me call it predominant. Another type of investment product that people invest in. No, don't let me say it like that. So there's something you call, let me just say it, there's something you call separately managed accounts. Yeah. What we in my own field we call standalone portfolios. Standalone portfolios. Standalone portfolios is also the same thing as SMAs. Yeah, it's also the same thing as separately managed accounts. Now we use this kind of fund management service for, as they said it here, institutions and predominantly HNIs. because they are the ones that can have substantial assets. So if a client walks into my organization now and says he has 500 million naira to invest, I'll most likely take him through what? An SMA. Than telling him to come and invest in a mutual fund. Yeah, because his asset class, or rather, his portfolio is large enough for me to manage it alone. That's why we call it standalone portfolios, rather than me pulling it into what? Into a mutual fund. Because what happens now is, if I put you in a mutual fund, then you become a significant unit holder. And because you're a significant unit holder, you can distort, based on your investment decisions, you can distort the performance and activities of my mutual fund. So rather than me putting you in a pooled investment scheme, I will put you in a standalone portfolio or a separately managed account. Yeah. So it's predominantly for, large institutional investors or HNIs, people that can give you $100 million and all that. Yeah. Now, I really don't know why the curriculum brings this into this conversation, but we have it there and it's a good to have. But the most predominant pooled investment product, aside from mutual funds, are ETFs. And ETFs have become predominant because, like I said earlier, over the years, people have preferred what? Passive investment. And this is the investment product that has fulfilled the need of passive investment, or passive investors rather. So it's the investment that passive investors significantly invest in. Now, let me make it there's a reading in your level 2 that speaks about this. So I try as much as possible not to go very deep. But what is an ETF? Just imagine a mutual fund that tracks a particular index and is listed on an exchange like a stock. That is what an ETF is. So let me say that again. An ETF is a mutual fund that tracks an index and lists to trade like a stock. That is what an ETF is. Now, like I mentioned earlier, the whole essence is to contrast mutual funds and ETFs. So what are the differences between a mutual fund and an ETF? Number one is this. During a mutual fund typically can be purchased or sold once a day. Short selling and purchases of shares are not allowed. However, let me start like this. First difference, for mutual funds, you buy it from a fund manager. For ETFs, you buy it off an exchange. Yeah. Number two is, for mutual fund, you can buy it only once a day. Yeah. However, for ETFs, they trade like stocks. So as long as the market is available, you can buy and sell and buy and sell and buy and sell and buy and sell and buy and sell. Yeah. Number three is, for mutual funds. How will I explain it now? For mutual funds, the payment of dividends is at the discretion of the fund manager. Let me say that again. For mutual funds, the payment of dividends is at the discretion of the fund manager. However, for ETFs, dividends are paid annually. Yeah, dividends are paid annually. Now, let me see what again. I think those are predominantly major differences. Yes, another thing again is, for mutual funds, there's a possibility that there's a minimum balance. For mutual funds, there's a possibility that you would have a minimum balance. For ETFs, you can buy 1 unit, as low as 1 unit. There's no minimum balance. There's no minimum balance. Yeah, there's no minimum investment amount. Sorry, for mutual funds, is in minimum investment amount. For ETFs, there is no minimum investment amount. Yeah, it's all right. That's the differences between money market, a mutual fund, and ETFs. Now, we now have something called hedge funds. Have you guys heard of something called hedge funds before? These are the guys that used to, cause problem in the market. They can do and undo. Now, first thing first, hedge funds are technically you are making an investment, but they are predominantly driven by investment strategies. So your decision to invest is not what you want to invest in. It's based on what your strategy is telling you to invest in. So if I have a particular strategy, and from the look of things, the only way I can achieve that strategy is by buying land and selling. Yeah. Tomorrow, I can decide to change and say I am not buying land again because my strategy is now telling me now to go and be buying houses. After 3 months, I can change again and say, oh, it's now stocks I'm buying because my strategy is telling me now that it's stocks. So the decision to invest is not based on the underlying assets. It's not asset driven. It's strategy driven. Then secondly is hedge funds are for big boys because the minimum investment to invest in the hedge fund, they can tell you minimum is $150 million or $10 million minimum to invest. Unlike mutual funds that are very, to be honest, very retail focused. Yeah, hedge funds are more premium, luxury kind of, HNIs and all those guys. But mutual funds is predominantly retail. Yeah. So, and one thing again you should know, yes, hedge funds are private. They don't make noise. They don't do adverts. They don't call the public. There's something we call qualified investors. So they only chase qualified investors. They don't chase every man. It's just qualified investors. And they will call it, what is a qualified investor? A qualified investor is an investor that can tell the regulators that I know what the hedge fund guys are doing with my money, meaning they understand what is being done with their money. Yeah. So unlike mutual funds that are public and bugberu, so mutual funds are public and bugberu. Yeah. So that's the difference between hedge funds and mutual funds. You see a lot of hedge funds in your alternative investments. Another bunch of guys that we have in the pool investment world is are called the private equity funds and the venture capital funds. Private equity funds. So these are alternative investment funds. You see all these guys under alternative investments. So these are the guys that invest in privately owned organizations. So they are not the guys that go and buy shares off an exchange. Venture capital, I'm sure you guys must have heard a lot of venture capital guys. Those are the guys that are ruling, that are very predominant in the fintech space. Yeah, a lot of venture capital funds putting their money in, so these are the guys that look for small cap stocks, startups, and all that. Guys that they don't really have a lot of capital. They have the idea, they have the brain box, and all you do is just put your money on the brain box and you keep your fingers crossed and hope that the person would succeed. Because the moment the person succeeds, it increases your capital. It increases your capital. Yeah. So, like I said, you see all these guys under your alternative investments. They will make a lot of sense. And with this few points of mine, I am done with this particular reading. Any questions? Now, sorry, what are the differences between these guys and money market? And sorry, and mutual funds. One, mutual funds don't invest in privately held organizations. Yeah, so that's why we've been able to carve out this space called private. Because somebody is saying, so are you telling me that if a mutual fund cannot invest in privately held organizations, then what about people that want to invest in privately held investment, but they want a commingled stuff? So that's what brought about private equity funds. Private equity funds, minimum entry is also, like I said, HNI stuff. It's large institutional stuff. They can tell you the minimum is $100 million for you to be able to enter $100 million, because what you want to use the money for, you want to invest in a company, and the company want to push in about $2 billion. So somebody like, and that's why I used to tell people that what's his name, Mr. Warren Buffett manages that whole company of what's that name of his company again, sir? Berkshire, something Berkshire for Berkshire Hathaway, yes. Berkshire is like a private equity fund, private equity company, because the only essence that company does is takes on significant investments in companies, and it doesn't technically go through. I heard most of the time it doesn't go through the public market, so it does direct. So it goes, analyzes your financials. I'm sure tells you that, oh, you guys need capital in order for you to be able to sustain. And I'm going to give you that capital, and in return, you are going to give me X number of shares. Bam. And everybody's happy. Everybody goes home. So, to these few points of mine, once again, I have come to the end of this reading, and I'm going to go around the class. Esther, as the only lady in the house, do you have any questions? Introduction to risk management. Risk is, so let me ask you guys a question in this class. What is risk? When you hear risk, what comes to your mind? Who wants to go? Mr. John, when you hear risk, what comes to your mind? Is Mr. John with us? Hello? Is John with us? Okay, John is not there. Who wants to try? John is not with us. When you hear risk, what comes to mind?
Hello?
Yeah, I'm with you.
Yeah, when I hear risk, something like danger, something like danger, yeah.
Danger. Wow. You need this your own self. This one will now pass. It pass as it be. Let's stick to the context of finance. When you hear risk, what
Okay.
comes to mind?
Okay, I would say it is a possibility that an outcome might not be favorable.
Probability to it.
Possibility of an unfavorable outcome. Okay. Any other person? I like that. Any other person? Risk. What comes to mind? Damila, you want to try? Hello, Damila, are you
Hello.
there? Yeah.
Sorry, a call came in. I was trying to reconnect back. Yeah, risk. When we talk about risk, we are talking about possibility that something bad might happen. You might not. You have the likelihood that you don't have something favorable happening to you. So, and risk is something that you cannot eliminate. You can only find a way to reduce the outcome.
Okay.
That is what I can say.
Okay, I like that. I like that. I like that. You've said a lot, but I'm still looking for one word. Esther, let me look for your trouble. What comes to mind?
Same thing everybody has said. Just
I know
possibility.
that's what you're going to say.
Exactly.
Okay. Have you ever thought about it? When you hear risk, do you think about loss?
Yes,
Yes.
Mr. Ahmed, that's why I said danger.
That's why you said danger. But you know, in
Yeah.
the world of finance, when we say risk, most people always tend to think about loss. But to be honest, Michael's response is what we always say. And for me, I would use the word uncertainty. So the fact that you are going to have an uncertain outcome, an outcome that you cannot predict, that is what risk is in finance. So I make an investment, but I'm not certain. You use the word certain. I am not certain that at the end of my investment, I'm going to get my money back. That is risk. Yeah. Now, it might not necessarily be loss, because what a lot of people think about is, oh, loss. No, it might not be loss. It's just the fact that I am not thinking about loss. I'm just thinking that something might go wrong during this my investment that might jeopardize my investment. It might not be a fact that my money is lost. It might just be a situation whereby maybe I was going to get my money on Monday, but I didn't get my money on Monday. I got it on Monday the next week. But something happened to my investment. So that's why we always say that when you think about risk in finance, you shouldn't automatically think about loss. It might not necessarily be loss. It might just mean a case that outcome that you predict, that outcome that you are expecting might not end up being that outcome. It might even be better than that outcome. So it might not always be bad. It might be goodest than the good that you're expecting. So if you understand my point, is it might not necessarily be a bad situation. It might not necessarily be a bad situation. It might even be a better situation. But for the fact that this outcome that I am expecting might either go up or go down is what we call risk. So risk is not always the negative side of things. It's also the fact that there's also a positive side of things. So risk is two-way, not one way. Now, as they always say, in life, you cannot run away from risk. Risk is like the most important part of any economic activity. I can wake up today and say that I'm going to work today, and I might not end up getting to work. It might not necessarily mean that I died. It might just be a case of something happened. I wake up in the morning, my tire is flat. I'm going to work, and for one reason, a trailer falls on the way, and I don't get to work. So risk is part of life, is inherent in our living, is the fact that we are waking up and are moving, and these two legs are working. There's risk. And as Damilare said, you cannot eliminate risk. Risk is very important. I always tell people that if you don't, in investment, if you don't take risk, you can't make money. The fact that you have deployed capital to an investment, you have already taken risk. So if you do not deploy that capital, there's no risk. So in order for you to invest and make money, there has to be risk. So the whole essence of this reading is to sort of introduce you to the concept of risk, yeah, and to also understand how risk is being managed. Because like I said, you cannot eliminate risk. You can only manage risk. Yeah. Okay. Now let's talk about risk, the risk management process. So, like I said, what is risk? Remember when I said this? Exposure to uncertainty. Uncertainty is the key word. The fact that I don't know what will happen at the end of my investment is already bringing about risk. It might either be positive, it might be negative. For the fact that I don't know what I'm going to get, there's already risk. Yeah. So risk is also the concept used to describe all the uncertain environmental variables that lead to variations in and unpredictability of what outcomes. That's what I just said now. The fact that you cannot predict your outcome, the fact that you don't know what your investment outcome will be, that is already bringing in an uncertainty, and that uncertainty is risk. Now, what is risk exposure? Risk exposure is when you have opened yourself up to that uncertainty, such that if anything happens, how are you going to be impacted? That is your risk exposure. Let me say that again. Risk exposure is the fact that I have given up something to expose myself to that risk. So the fact that I have carried out an activity such that this risk that we are seeing, if it should crystallize, I will be significantly impacted. So that level of impact is what we call risk exposure. Yeah, that level of impact is what we call risk exposure. So if I don't buy Dangote cement shares, I don't have any risk exposure. But for the fact that I have taken on Dangote cement shares, I have 1 million units. If anything should happen to Dangote today, I will be impacted. Now, the question I ask myself every time is, what is going to be? The question I ask myself every time is, what would be the impact to me if something should happen to Dangote? Yeah, that is my risk exposure. Yeah, okay, moving on. Now, I like this definition a lot. Every time I see this definition, I'm always happy. Every time I see this definition, I'm always happy. Always happy, because this definition is the true definition of risk management. Risk management is the process. Keyword, process. Is the process by which an organization or individual defines this word. You define your level of risk that you want to take. What level of risk do I want to take? Measure the level of risk taken, meaning I have defined what I want to take. I am looking at what I have taken, and I am asking myself, or I am adjusting the level of risk that I have taken to the level of risk that I have defined as what I want to take. So you tell yourself, my level of risk that I want to take is 10%. Then I take on risk and I realize the risk is 12%. Then what do I need to do? I need to adjust that 12% risk to go to align with what? With the level of risk that I've said I want to take, which is 10. That is what risk management is all about. Yeah. And it ends by saying, with the goal of maximizing the company's or portfolio's value or the individual's overall satisfaction and utility. Yeah. So that is risk management in a nutshell. Define the level of risk you want to take, measure the risk that you have taken, adjust the level of risk that you have taken to what? To the level of risk that you have defined that you want to take. That is risk management. Yeah. So at every point in time, you can't be in a world, or you can't run an organization or run a portfolio management. You can't manage a portfolio and you do not think about what? Risk. Risk is very, very critical. Very, very, very critical. Yeah. Okay. Now, moving on. What is the risk management framework? Risk management framework. The LOS is describe the features of the risk management framework, define risk governance, and describe the elements of effective risk management. So there's something we call enterprise risk management. I'm sure some of you might have heard of that before. Yeah, we're going to look at that very soon. But before we do that, there's a key document, a key framework that defines, that governs the whole essence of risk management. And that's what we call the risk management framework. Yeah. So a risk management framework flows logically from the definition of risk management that was previously given. It is the infrastructure, process, analytics needed to support effective risk management in an organization. So you are creating a framework that supports the risk management decisions and risk management activities of an organization. And the key elements of this framework are: 1, risk governance; 2, risk identification and measurement; 3, risk infrastructure; 4, define policies and processes; 5, risk monitoring, mitigation and management; 6, mitigation communication; 7, strategic analysis and integration. Let's start with the first one. The first one is called risk governance. Now, what this is saying is there has to be a body that sort of take responsibility for the risk management activities of that organization. There has to be a body that sort of, I don't want to use supervises, I'll stick to my word, takes responsibility. So they define how the risk management of that organization should be. They define, remember what we said in that definition, they define the level of risk the organization should take. Everything that has to do with risk management flows from that body. And most times that body is your what? Is your board of directors. Yeah. So it's a top, there's what we call risk culture, topmost level. So that board must sort of be breathing risk management. Yeah. That's what your risk governance is about. That body that takes responsibility and the body that defines the level of risk and how the risk culture and activities of that organization will be. That's risk governance. 2, how do you identify risk and how do you measure risk? So, which still aligns with your risk infrastructure. What tools are you going to be using to identify and measure risk? So, what is your methodology for identifying risk? What is your methodology for measuring risk? Yeah. Then, what are the tools, which is what you call infrastructure? What are the tools that are available or have been created to be able to identify and measure this risk? Then you need to understand what policies and processes are going to be. So, what policies and processes flow within that risk management function in your organization? Yeah. So, how are things done? Who is looking at what and all that? Yeah. Then you now have risk monitoring, mitigation, and management. Remember what risk management is. You are adjusting the risk that you have taken with the defined level of risk for the organization. Yeah. So you need to be able to monitor the risk. And that's why I always tell people that risk management is not reactive. Risk management is proactive. So because I am in the environment, I am monitoring the risks. I've been able to identify a particular risk and tell myself that this risk or this thing I'm seeing is going to lead, is a what? Is a risk factor. Yeah. And as a result, I am monitoring. As a result, I'm telling myself that, apologies, just got distracted. I'm telling myself that, see, I need to start thinking well ahead on how I will mitigate this risk if what I am saying what crystallizes. Yeah. So an activity comes out and I've been able to say, this activity poses a risk on my organization. Yeah. And as a result, I need to monitor my organization. I need to monitor that activity and tell myself, see, if anything should happen, and this thing escalates beyond what I expect, this is the impact that I feel is going to be on my organization. So, hence, I need to be able to monitor that activity, and I should have apologies. I should have put down all the necessary mitigating actions. Meaning that if this thing should crystallize, we're going to do A, B, C, D. So all we're just doing is we're monitoring that risk or monitoring that activity to ensure that the moment that thing crystallizes, we start A, B, C, and D immediately. That is what risk monitoring, mitigation, and management. So how are you going to monitor? How are you setting up your mitigants and all that? Yeah. Then the last is communication, meaning that you need to communicate to the board. So if you are the risk officer or the risk manager in your organization, there has to be an adequate relationship with the board, such that you can communicate all the issues and everything that is happening immediately. Yeah. Then lastly is strategic analysis or integration. Now, what do we mean here? I want to create a scenario. So imagine that one organization has defined its level, let's just hypothetically, yeah, has defined its level of risk as 20. And the business is just taking a level of risk that is 8. So that means the business is leaving 12% risk on the table. And the company is not doing well because they are very risk averse. Yeah. So what does the risk manager say? So the risk manager does an analysis and puts down a paper to say, see, I feel that this organization will probably generate more profit if they can be slightly more aggressive than the level that they are. So let's take the level of risk from an 8. Let's move it to a 15 or 50 or double it to a 16. We're still well below our defined level of risk, our risk tolerance. That's what we call it. We're still well above our risk tolerance, but we'll be generating times 2 of the money. Might not be up to 2, but at least times 2 of what we're earning now. So that is what we call the strategic analysis and integration. So when we talk about risk management, we're not always, which is what I always try to tell people. When we talk about risk management, we're not just looking at the negatives. That's what a lot of people always do. Always focus on the negatives. No, there are also positives. So the risk manager should be able to tell you, see, bros, increase your risk a bit. If you increase your level of risk a bit with what you are doing, you're going to earn more money. It's not at every point in time that the guy will be, it's only bad things that the guy is pointing out. Yeah. So these are the factors of your what's that thing called? The factors of your risk management framework. Remember when I talked about enterprise risk management? So enterprise risk management is an overarching governance approach applied throughout the organization and consistent with its strategy, guiding the risk management framework to focus risk activities on the objectives, health, and value of the entire organization. Now, let me explain what this is about. Remember when I talked about risk governance, I said risk management must flow from the top. It must flow from the board. Everything in terms of risk culture, how you take risk, your risk tolerance, everything must be from the top. Now, what we have realized over the years is that when some organizations are tackling risk, they tackle risk on a case-by-case basis, a department-by-department basis. Yeah. And what we are saying is, no, that's not right. You need to have an holistic view. That's what enterprise risk management is. You have to have an holistic view of the company such that you are able to look at the organization as a whole. There might be some functions that are overlapping, But because you have an holistic view, you can understand those overlapping functions and how the risk plays across those overlapping functions. Yeah. So risk management is holistic. Don't do your risk management in buckets. Health and safety, what's your risk? This look at it from an holistic. What are the risks that this organization as a whole is exposed to? Not department by department. That's what enterprise risk management is about. Okay, so let's move on. Now, this diagram that you have here, this very nice diagram, is some sort of like your risk management framework that the CFA has sort of provided to us. Yeah. So this is your risk governance, this is your board. It determines your risk goals. You have the management that determines the strategies to achieve those goals. The board sort of determines the risk tolerance. Then you guys as the management sort of carry out the risk activities in line with the risk tolerance. Then you have the risk budgeting that sort of looks at how risk is shared across different risk activities of the organization. Then you have your risk exposure, yeah, to determine how what level of exposure you have to the different risks that you have been able to identify. Then you have the policies and the procedures that sort of drive the activities within the organization. So if your risk exposure is in line with your risk tolerance, what do? You just move on and you monitor the risk. However, if it is a no, then you now have to go back to something we call risk mitigation and management. So that means you need to mitigate that risk. And that's where you adjust the risk. Yeah. So you go back into looking at the activities that you have gone, determining the risk factors, exposures, until you get a yes before you can move forward. If you don't, you keep going around in this circle until you get a yes and you monitor. So you establish your investment infrastructure, which I call the tools that you use. Then you are identifying and measuring your risk, you are monitoring your risk, then like that. Okay, fair enough. So let's talk about another thing that's kind of interesting. Yeah. Hold on. Yeah, so risk governance, which is what I've mentioned before, the enterprise view. So enterprise view of risk governance is your enterprise risk management. Sorry, the enterprise risk to risk governance is enterprise risk management, which is what I've explained before. It has to flow from the top. Yeah. So everything is from the governing body. Can you see? Risk governance is the impact of the governing body of the organization on the risk management framework. So it has to come from the top. But the key takeaway from here, and I've mentioned enterprise risk management. Yeah. So having holistic view of the business. Very key. There's something I want to talk about. Yeah, risk tolerance. Now, there's something here that you need to take home. Every organization must have a risk officer. Please remember that. Every organization must have a chief risk officer, and the chief risk officer is reporting directly to the board, not to the CEO. Is not so, and the CEO cannot be the chief risk officer. So the chief risk officer has to be somebody that's different from the CEO, different from the CFO, and that person is reporting directly to the board. Yeah, reporting directly to the board. Very, very key for risk governance. Very, very key. Now, let's talk about risk tolerance. Risk tolerance is the level of risk. So, like they said, perhaps the most important element of good risk management, good risk governance, is the risk tolerance discussion and decision within the governing body. So, what level of risk do you want to take? That's what risk tolerance is. What level of risk? And if you remember my definition of risk management, I said you define the level of risk to be taken. That is, you define your risk tolerance. So what level of risk do you want to take? What level of risk can you tolerate? What level of risk should you take that will not impact the organization negatively? That is risk tolerance. Yeah, that is risk tolerance. Very, very important. So you have to establish the organization's risk appetites. What level of risk do you want to be taking? If you can't be saying that you are risk averse and you are doing BDC or you are doing work that business that can all your money can blow up at once. Yeah. So you need to understand that in portfolio management, we say your risk tolerance is your willingness and your ability to take risk. Yeah, your willingness and your ability to take risk. What level of risk are you willing to take? Do you have the ability, the capacity to take on that risk? If both of them are yes, then you can take risk. So very, very key. And like I said, this risk tolerance is determined by the what? By the board. Is determined by the board. So the body of governance. The body of governance. Very, very key. Very, very key. So you need to understand risk tolerance. Okay. Moving on. What else is here that I think I can quickly throw out you guys? I don't think there's anything here. Yeah. So another thing again is once risk tolerance is determined, 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 the overall risk framework should be geared towards measuring, managing, and communicating compliance with the risk tolerance, getting the risk exposure in line with the enterprise risk appetite. That is what I have defined to you guys since the beginning. Risk tolerance is like the most important thing for risk management. You need to be able to determine the level of risk you want to take. That is risk tolerance. If you don't have that, that's your benchmark. If you don't want that, you're just running helter-skelter. Just that you have to be able to say, this is the level of risk we should be taking. Anything above this, there's problem. Yeah, anything above this, there's problem. And that's why in some organizations will tell you, oh, your risk is we need to go and get board approval in order for us to be able to take on this transaction, because this transaction's risk, the risk we see in this transaction is above the level of risk that we should be taking as a business. So that's like this risk tolerance is like the most important thing for risk management. Okay, risk budgeting, like I had mentioned before, risk budgeting picks up from risk tolerance. Yeah. Whereas this is an important part. Whereas risk tolerance focuses on risk appetite and what is and is not acceptable. Risk budgeting has more specific focus on how risk is taken. How do you allocate risk amongst? So we have determined the overall risk for the business, which is risk tolerance. Now, risk budgeting now talks about how do we allocate that risk across our different business activities that would not impact our risk tolerance. That's what risk budgeting is all about. That's what, in a nutshell, that's what risk budgeting is about. How do you allocate that risk such that, and they said one of the easiest way to allocate that risk is using a metric, a risk adjusted metric, yeah, that talks about the maximum level of return. That so you allocate more risk to a business that generates the highest level of return per unit of risk. You allocate, let me say that again, you allocate more risk, you take on more risk, you are more aggressive with a business that generates the highest return per what? Per unit of risk. So we call that the risk adjusted methodology to using this, to doing the risk budget. Yeah. Okay. And it helps a lot. Interestingly, it helps a lot. Because so let me say Mr. A and Mr. B are taking on risk for the company. Mr. A is generating more money for the highest, for the low, for per unit of risk. The best idea or the best decision to make is to give him more capital. That means he's more efficient with his use of what? With his use of risk. Okay, now let's move on. Yes, identification of risk. Identification of risk. We have two types of risks, two categories of risk, rather. We have two categories of risk, financial and non-financial risk. Financial risk is the risk that emanates from the financial space. It's a risk that originates from financial markets. That's financial risk. It has to do with finance. While non-financial risk is a risk that originates from outside the financial market. So basically, if you are within if you are in the financial market, there are factors within that financial market that create risk. While there are factors outside that financial market that also create risk to you that are inside that financial market. Yeah. So let's start with financial risks. There are three predominant types of financial risks. There are three primary types of financial risk: market risk, credit risk, and liquidity risk. Market risk is risk that arises from changes in price of your financial assets. As long as your financial asset has a price and that price is not stable, that price is determined by demand and supply, then you are exposed to what we call market risk. You are exposed to what we call market risk as a result of that. Hold on, please. What was I saying? So I said market risk is the risk that arises from changes in prices. As long as your asset has a price and that price is not stable throughout your investment period, then you are exposed to market risk. So that's market risk in a nutshell. Market risk is the most, for portfolio managers, is the most, I won't say disturbing, is the most important risk, the risk that you cannot avoid, because throughout, all assets have prices, and as long as they are moved by demand and supply, which they all do, you are exposed to market risk. Now, the other risk is, so this is market risk. The other risk is called credit risk. Credit risk is the risk that somebody is going to default. Yeah. So somebody won't fulfill that obligation, financial obligation in the future. Meaning that I give you my house, or rather I borrow you money, and on the day you're meant to pay me back, you disappear. So that's what credit risk is. So a default in obligation, inability inability for someone to fulfill their financial obligation, or failure to fulfill their financial obligation, which leads to a loss of capital. Yeah. Then the next is called liquidity risk. Yeah. So liquidity risk is the risk that you are exposed to as a result of the inability to convert your assets to cash. Yeah. Inability to convert your assets to cash. That's liquidity risk. So the fact that you have bought an asset and that asset, anytime you want to sort of turn it to cash, you must always get a haircut, meaning that there must always be a discount for, or a charge, or a loss in value as a result of your investment. Yeah. So that's liquidity risk. Now, another under liquidity risk, yeah, could be for for assets that trade on an exchange like stocks. We have something we call the bid and ask spread. Yeah, so the bid and ask spread also measures liquidity. Yeah, so once your bid and ask spread is wide, we always say that there's illiquidity in that asset. So you can also look at that liquidity from that part. But in all essence, is ability to sell an asset for good value. I mean, and which is obviously driven by the asset being liquid. Yeah. So if it's not liquid, you won't sell it for good value. Now, those are the three types of financial risk. For the non-financial risks, we have different types. There are a lot. We have something called settlement risk. Yeah, so that's the risk where I expressed that during the week, settlement risk. So I bought an asset from someone, and the person didn't deliver it until 2 days after. So during that period where my money had left my pocket and I hadn't gotten the asset, I was exposed to liquidity risk. I was exposed to settlement risk. So settlement risk is not that the person has defaulted. Settlement risk is just that due to some certain reasons, the transaction could not be completed. So it's a transactional, I'll call it, it's more of a transactional risk. I bought bread for my malam, but because my bank was down, my bank app was down, I didn't have cash. Yeah, I was finding it difficult to pay the malam. Yeah, during that period, two things could happen. I could tell the malam, oh, my app is not working, take back your bread and go. But because it was a bread that was not in a nylon, and the fact that my hand has touched the bread, it was difficult for me to return it. So at that point in time, I was exposed to myself, or rather the malam was exposed to liquidity risk, because if my app doesn't work, I won't be able to pay, man. I couldn't return the bread. So I was exposed to settlement risk. So for as long as my app was down, the malam was exposed to settlement risk, because I can't return the bread. Yeah. So that's settlement risk. It happens a lot in the market. You see that all the time. Yeah. So although financial consequences are high, the root source of this risk is the timing of the payment process itself. So like I mentioned, the issue really is how long it takes when there are delays in me paying, or somebody paying me for what I've sold or what I bought. Okay, so organizations face two types of risk that are applicable to law, and we call it legal risk. Yeah. So the first one is the risk that you can get sued. Yeah. So you do a transaction, the transaction doesn't go well with your counterparty sues you. That is legal risk. Another risk is under the legal space is you sign a contract that had clauses that were harmful to you. So they have harmful clauses and you did not know, probably due to oversight and all that, such that in the future, you signing that contract, something comes to bite you. Yeah. So that's legal risk. So we call one the possibility of you being sued. Two is the possibility of you getting into contracts, or binding yourself to contracts that have harmful clauses. Yeah. Now, another type of financial risk that we like to group all these guys into something called compliance risk is regulatory risk, accounting risk, and tax risk. Regulatory risk is you might break the law, you might break the rules. So there's some rules and regulations that you must follow, and you might breach one of those rules and you did not know, and you get a fine. That is regulatory risk. Accounting risk is as a result of accounting standards, IFRS, and all those guys. Because of one thing or the other, you did not apply a particular IFRS rule adequately, and you get fined. Then the last one is tax. I'm sure you guys know that tax evasion is bad. Avoidance is good. Evasion is the one that is an issue. So for one reason or the other, you decided to evade tax and you get slammed. Bam. Yeah, so we bucket all those guys into compliance risk. And the reason why is because all these guys have to do with certain rules and regulations. So which you must comply with, which is why we call them compliance risk. So you fail to comply, you get a fine. Another risk is model risk. Well, I'll pack this guy because I don't want to. Model and tail risk, I would not talk so much about them, but it has to, there are risks that have to do with people that do modeling, financial models and all that. Yeah. Yeah, I think that's pretty much, yes, the master of the game, the guy called operational risk. Operational risk is the risk that arises from inadequate or failed people, systems, and internal policies, procedures, and processes. So when you have, I always say operational risk is failure system, processes, and people. Failure in systems, processes, and people. And in all, I always tell people that, to summarize it, operational risk is the risk that arises from failure in system and people. Because system is your technology. People, outside technology, it is people. And the only reason why a process can fail or fraud can happen is because of the people that you have in your organization or you have around the picture. Yeah. So that's operational risk. Okay, so operational risk. So that's basically operational risk. One of the biggest in the financial sector. We like to talk about this guy, Nick Leeson of Barings Bank. Destroyed a 200-year-old bank as a result of failure in process. So the guy went behind the processes, decided to do some transactions that were not in line with his company's rules and all that. And it resulted in him taking on huge losses that led the bank to ruins, to bankruptcy. Yeah. So when we talk about operational risk, we like to talk about that. Now, in the new world that we're in, because this was not in the former curriculum, but it's good that this has been updated. We are now moving in a digital world. So cyber risk has now become very, very important. Yeah. So it has become a significant aspect of operational risk. So most times when I talk to risk management guys, I always talk about IT risk. This because to me, I call it IT risk. Yeah. So cyber, the possibility of you being hacked. Yeah. So what security do you guys have? How have you been able to protect your organization from hackers, from scams, from spams, and all that? Yeah. So cyber risk has become very, very, very important. Yeah. Then there's this data protection and all that is very important. So cyber attacks all over the whole place, data breaches and all that. Yeah. Then another part is terrorism. Yeah. There's no how I can see this curriculum has improved. Yeah. So terrorism also has come under, operational risk. Like what we saw in the World Trade Center, yeah, in 1999, where 2001, where it was blown up. So you need to think about that. Then you now start thinking about business continuity. You guys must have heard of that before. Yeah. So what's your business continuity plan when such attacks happen, how do you guys remain important, remain in the business? You guys don't go down. Yeah, we do that. When I was in Stanbic, we used to do that a lot. Data recovery, that business continuity plan, data recovery, go and pack. I can remember then they used to call something box. Your something box. Anyway, forgotten what that is. Anyway, now moving on, we have another risk called solvency risk. The risk of you going bankrupt. Yeah, this is the risk that organization does not survive or succeed before it runs out of cash. Yeah, so the possibility of you going bankrupt. That was the issue with Lehman Brothers. So Lehman Brothers experienced something we call solvency risk. Yeah, so they ran out of cash and the business could not, like I always say, cash is king. When a business does not have cash, then there's a problem. Yeah, okay. Then there's something that you guys heard called run on the fund. Yeah, where when there's an issue with the fund manager, everybody just keeps going to the fund manager to collect their money. Exactly. What happened to what's that company called? Signature is not Signature Bank. SVF. Silicon Valley Bank. Yes. Silicon Valley Bank. That was the issue with Silicon Valley Bank. So Silicon Valley Bank to experience solvency risk. Yep. Okay. So let me see which other risk do we have here. Which other risk? Now, for individuals, you also experience. So everything we're talking about for business. So for individuals, you experience two important risks. No, you experience three important risks. One is the one we know, which is the health. So health risk. That's why you have HMOs. Yeah. So HMOs are the guys that are providing like an insurance against your health risk. So anytime you fall ill, HMO steps in. Yeah. So there's health part of it. Now, aside from health, there's also the one we call mortality risk, which is dying young, basically. Yeah. Nobody wants to die young. So a friend of mine was telling me about a guy that passed one way in Yaba. Police caught him. They started harassing the guy, told the guy to go and get money to bail himself. And on the way, the guy died. Yeah. So that's dying young. That's mortality risk. A lot of people don't like talking about it, but it's there. Yeah. And that's what insurance is there for. It's there. Then the next is longevity risk. The next is longevity risk. Now, longevity risk is the risk that you outlive your financial resources. You outlive your financial wealth. You live so long that after a while you get broke. That's longevity risk. And that's what most people, I know most Yorubas, that's what they pray for. They pray against that. I won't live so long that I'll not be poor. That I'll not live for people to fend for me. So that's longevity risk. Those are three risks that as individuals that you'd always face. Yeah. Dying young and living so long that you become super broke. Yeah. So those are your different types of categories and types of risks. Now we have the next is interaction between risks. Interactions between risks. Now, what do we mean by interactions between risks? What we mean there is that a risk might not necessarily happen by itself. Yeah, a risk might not happen by itself. Meaning that, all right, let me use a risk might not happen by itself. Let me say something might happen now that might trigger two risks at the same time. That's one side, one aspect to it. The other aspect to it is something might happen that will crystallize a risk, and that risk that crystallizes will crystallize another type of risk. So most of the time, you would see operational risk that leads to credit risk. So somebody has taken up a loan the business is going on, then a fraud is committed in the organization, and as a result of the fraud that was committed in an organization, the company can no longer what? Pay its debt, because all the money that the company has been stolen. And the company, the money that he has gone to take it, use it to go to police station and court to be able to arrest the person that committed the fraud. So that is a typical example of interactions between risk. Another one that can happen is something we call, so a simple example of an adverse risk interaction is what? Counterparty risk. Yeah. When trading a derivative contract, it is important to consider the cost of counterparty risk. Yeah. Suppose party A buys an out of money put option with a strike price of 1,000 yen. A contract theoretically worth 100 yen entitled him to as much as 1,000 yen from counterparty C. If an underlying equity index is down, but there is a 20% chance that C could default. Yeah, so let me explain. So what is what they're talking about? Yeah, so may you get into a contract that says that in the future, yeah, you deliver cars to me if the price of car is 1,000 naira. Now, in the future, price of car is 1,000 naira. So you need to what? Deliver car to me. But in that sense, you don't have any car to deliver. So what do? You default. Now, the reason why I got into that, so that default, that my counterparty defaulted is counterparty risk. Now, counterparty risk can now lead to credit risk on my part. How? So imagine that the whole essence of me getting into that contract is that when price of car is 1,000 yen, car is delivered to me. That car is now what I will now give Esther. So because I've experienced a counterparty risk here, I've been unable to fulfill my obligation with Esther. So that's a typical example of a summary of everything that they're trying to say here. Yeah. So what they're just trying to say here is a takeaway from this is never look at the risk singularly. Yeah, in isolation. Look at risk holistically. Yeah, try to understand what you are looking at and try to be able to tell yourself that, see, this risk is not just going to affect A, or it's not going to lead to only A. There's a possibility that it will lead to C. There's a possibility that if it leads to A, it can lead to B. That's what I'm just trying to talk about in terms of interaction between risks. Yeah? Okay. Okay, we're there done. Okay, let's move on. Measuring and modifying risks, drivers and metrics. Yeah. Describe methods of measuring, modifying risk exposures and factors to consider in choosing amongst methods. So first thing first, we have something called drivers, which is what I've probably been saying since. What are the risk drivers? Risk drivers are, like they said here, the origins of risk. Let me define it in a way that I think I can best explain this. Risk drivers are those actions that lead to risk. Remember, I've said that before. An action happens, and my understanding of my environment, I'm able to say, because of this action, there is now risk. I'll give you a typical example. Very typical example. A policy was passed in Nigeria that had to do with unification of FX, of dollars, the unification of the exchange rate. Yeah. And that is an action. That is somebody's policy. That is a risk driver. Because what that means is the moment I hear such a policy, I need to be able to tell myself as a risk manager that, this policy that has come out is going to have different impacts. That means I've been able to identify that risk because I've been able to know that this action is a risk driver. So you have to be able to know about the risk drivers for you to even say you want to identify the risk. Yeah. So you are now telling yourself that, CO, this unification of exchange rate is going to be, it's a significant one. It's a significant policy. It's a risk driver because it's going to lead to different risks. It's going to have different impacts. For instance, if I have a loan that I'm paying in dollars and they unify the exchange rate, and there's a possibility that exchange rate is going to go up. Yeah, because the true market, we all know, not necessarily the true market, but technically the true market was the parallel market. And the official rate is most likely going to gravitate to where the parallel market is. So the possibility of me incurring negative impacts as a result of that policy is there. So that's the point I'm trying to say is the risk drivers are actions that carry risk, actions that lead to risk, actions that have impacts that can distort your investments, that can distort the activities of your business. Those are risk drivers. Yeah. So you need to first understand the risk drivers before you can say you want to sort of measure. And that's what takes us to what? A metrics of risk management. So the number one metric of risk management that you can never run away from is the concept of probability. And I can remember somebody said it when we were defining risk, to say the probability of an event occurring. Yeah. So when you hear uncertainty, what should come to your mind is risk. When you hear uncertainty, what should come to your mind is probability of an event happening. Yeah. And that takes us to, so probability, like I said, you can never run away from it. It's very important in the world of risk. In the world of investment, we like to use standard deviation. Yeah. So standard deviation of returns. Standard deviation is a measure of dispersion. You see all this in statistics in your QM course. That's why I'm not really talking about it. So you know probability, you know about standard deviation and all that. But when you're talking about risk in the investment world, we like to use standard deviation. Yeah, how dispersed are the variables away from the mean? Yeah, so it's a measure of dispersion. Measure of dispersion. Yeah. Ordinarily, this is what's going to happen. So standard deviation is ordinary, this is what's going to happen. But what we're seeing now are far away from what we feel is going to happen. Then it means that there's what? There's risk. If what we're seeing is close to what we expect, then there's no risk. But when they are far away, that's when we have problems. That's when we have large measures of dispersion. Now, so this is talking generalistic. Yeah. Now looking to asset classes in themselves. Yeah. Specifically asset classes. For equities, we have a concept called beta that is a measure of sensitivity. While standard deviation is a measure of dispersion, beta is a measure of sensitivity. So how sensitive is the returns of a security to the returns on the market? This might not sound clear to you guys, but when we get to a reading that we're going to touch on, we talk about CAPM. I'll sort of be able to, I'll distill this better and clearer for all of us to understand. Yeah. Okay. But just take the points I'm making to say, just take the points I'm making in other aspects of your CFA level 1. You are going to touch on them deeper. Yeah. Okay. So in the world of options, derivatives, we have four guys that are very important. So we have the first concept called delta, the next concept called gamma, the next concept called vega, and the next concept called rho. So delta, gamma, vega, rho. Now, they are all measures of sensitivities too. But let me don't dive into them. They are all things that are going to see under derivatives. But for delta, so the whole concept of options is for you to have an underlying asset. So that's why it's called derivative. So it's a derivative. It has an underlying asset. Yeah. And when your option price is sensitive to the price of the underlying asset, what measures that sensitivity is called your delta. Yeah. While the sensitivity of the delta to the underlying asset is called the gamma. Then the sensitivity of the option price to volatility is called vega. While the sensitivity of the option price to interest rate is called rho. Like I said, it might not make a lot of sense, honestly, but when you get to QM, I'm sure, when you get to derivatives, I'm sure this is going to be very easy. It's one of the most easiest concepts in derivatives. Now, moving to the last, which is for bonds, you have something called duration. Yeah. So duration is the sensitivity of bond prices to what? To interest rates. Yeah. I will jump VAR. When you get to level 2, there's going to be something about VAR. This is not that detailed and all that. Yeah, but let's move on. So it's still under, all these are still under VAR. Yeah, all these are still under VAR and all that. Yeah, let's move on. Don't bother yourself. Okay. Okay, moving on. Yeah, I think that's pretty much it. Yeah. So let's move to risk modification. Risk modification. Now, let me explain something. Let me paint a picture for you guys. So this is the picture I want to paint. If I see an investment, and I want to take that investment, remember that I've determined my risk tolerance ab initio. So I've told myself that I cannot take risk more than 20%. But I see an investment and the risk on that investment is 22%. There are only 2 decisions I can make. Decision number 1 is to reject it, to avoid that investment because its risk does not align with my own risk. Number 2 is to accept to take on that risk, meaning that I would invest in that instrument and take on that risk. Yeah, such that when I take on the risk, remember that the risk of that instrument is higher than my own. So what I can do is I can now decide, which is where, so there's the avoidance and acceptance. Yeah, which is what we're talking about now. So I can avoid it and I can accept it. Then when I now accept it, I can now adjust my risk, which is where the modification. So I can now modify the risk that I am seeing. Yeah. And so the ways to modify is by, so this is, so they've even added diversification. Before it used to be self-insurance. So self-insurance is a case where I do not, so what do? I make provisions, which is what banks do. So for your non-performing loans, the risk that they are exposed to non-performing loans, what do they do? They make provisions such that when those non-performing loans crystallizes, they've already taken provision for it. Then the one that does not crystallize, meaning that the one that paid their money back, what do? They now do a reversal on more. They now do more like a taken of that profit, take on the reversal of that attempt, taking that reverse that provision to taking that money that the person has made. Yeah. Now, diversification is another interesting way, which is what I've taught you guys already under portfolio manager overview. Diversification is key. Yeah. So, like I said, another way is to not necessarily eliminate. You can't eliminate risk, but you can reduce risk by diversifying. So taking on another risk that has a different life pattern from the risk that you have exposed yourself to. Yeah. Now, moving on to still when you accept. Now, when you accept and you want to modify, there are two ways to modify. It's either you do risk transfer or you do risk shifting. Now, risk transfer is what insurance companies do, which is what? The insurance company buys the risk off me. So I sell my risk to the insurance company. Yeah. And or rather, no, it's not so. You're not buying. So that's what the problem is. Your payment for premium is your consideration. So basically, the insurance company is selling, yeah. So the insurance company is selling a product to you that mitigates that risk that you have exposed to. But in the world of risk transfer, really, what that means is you are moving that asset to that risk to another entity to take on. Yeah. And you now pay that person to take on that risk. That's what insurance companies do. And that's what risk transfer is. We must see insurance policy in the form of an insurance policy. Yeah. Then the next is called risk shifting. So risk shifting is what you do when you buy derivatives. What are you doing? You are changing the outcome of that risk. You are changing the outcome of that risk. So risk shifting refers to action that change the distribution of risk outcomes. You are changing. While risk transfer is you are moving that risk to someone else. Risk shifting is I am buying another instrument, buying an instrument that would edge away that risk. Yeah, it might not be a perfect edge, but nowadays people achieve perfect edge, meaning that I totally eliminate that risk. I don't even see that risk existing again. And that's the essence of what? Derivatives. Yeah, that's why we are teaching you, or you guys are taking on a derivative course so that you can learn how to shift risk and learn how to shift risk and learn how to shift risk. So let me give you guys one interesting thing I did in my office. Yeah. So I bought a bond, a 10-year bond for my clients. Now, as you all know, there's an inverse relationship between interest rates and bond prices. So when our president was coming in, he was singing the song of low interest rates. And we started seeing interest rates going lower. So we all expected that interest rates were going to go lower. So what do? We bought long dated bonds. Then all of a sudden, interest rates reversed. What we don't like is when you are long a bond, meaning you've bought a bond, you don't like when interest rates starts to go up. It makes you uncomfortable. Yeah, you start to make losses. So what did I do? Should I sell the bond and crystallize small losses or earn small gains on my investment? So what did I do? I entered a repo transaction. So what I did is I entered the repo transaction, gave my bonds to someone, and I collected cash. Now that cash that I got, I've used it to invest at higher rates. Yeah, such that at the end of the period, when I see that things have stabilized, what do? I get my investment back that I have made on the high yields, high returns. And so more like a short-term investment. Yeah. So really I fixed deposits, high returns, take it and use it to buy back my bonds. So what I've technically done is that profit I made, the profit I made from the cash that I got, I've used it to what? I've used it to shock. That's the right word. I've used it to, what English is running out of my head now. I've used it to reduce the losses that I have incurred as a result of higher interest rates on my bonds. So that already for me is an example of what? Risk shifting. Yeah. So I saw a risk, I saw rates were going up. I asked myself, how will I mitigate myself from this? Should I sell off the bonds and take on the risk and take on the losses? I said no. I still need to hold these bonds because these bonds have a great value in my portfolio. So what do? I did a repo transaction. Yeah. So that's risk shifting. Yeah. And I think we have come to the end of this reading. How do you choose which method to use? Either risk shifting or risk transfer or self-insurance. Now, what we always tell people is you need to do cost and benefit analysis. Yeah. Cost in what sense? For everything that you do, there's a cost. And for everything that you do, there's a benefit. So look at what they did here. As with all decisions, the trade-off is one of cost versus benefits that are weighed in the light of the risk tolerance of the organization. Yeah. So what we're saying is you need to be able to do a cost and benefit analysis in line with your risk tolerance. So not taking cognizance of the risk tolerance. Let me use it like that. Taking cognizance of your risk tolerance. So different method. They all have different costs. They all have different benefits. The one that gives you the best benefit for the least cost is the one that you should take. Basically, that's what they're trying to say here. You can't take that out the window. They all have different benefits and different costs, but the one that suits and aligns with your risk tolerance is most likely the one that we would advise you to take. With these few points of mine, I am done with introduction to risk management. Any questions? Any questions? Any questions? Are you guys still with me, or you guys have slept off? Any questions?
No, we are with you.
Yeah, with you,
Yeah,
with
me.
you, sir.
Okay. So I've come to the end of this reading, and I think I would say I've come to the end of this class. I think this is a good place for us to stop. Please try to tell other people that they should please come for the class that we're going to have next week, because by next week we are going to move into risk and return 1. Yeah, and that's like the most important reading for your portfolio level 1.